philanthropy and a family office's investing is quite separate from each other. And depending on the size of the family office, its foundation or its family foundation or whatever it might be is oftentimes run by different people than they're actually profit-making. So impact investing is a perfect storm in the way that it's between the foundation and between the family office. So both of them have to communicate that, yes, this is appealing to us because of the impact or helping others, but it also actually provides a very good return. And that's really probably the biggest problem, is to get the two areas of most family offices talking, because they tend to be in their own little silos.
Welcome to America Dreams. I'm here today with Chester Woolley. Chester, welcome to today's show.
Thank you so much. I appreciate being here.
So, Chester, you have a remarkable career, and before we move into your journey into the field of venture capital, I'd like you to share some of your early experiences and how you moved into the field that you're in now.
Great. I appreciate Alan, yourself and all that you do, by the way, to publicize things. So I think it's a great opportunity for me. But I was actually, in the end of the day, raised mostly in San Diego, and then went to college. And when I came out of college, my first job was and it's a little bit humorous that my first job was with a chairman of a big financial service company. And his first assignment to me was to take a look at one of our divisions within the company and say, why this division wasn't doing well. It happened to be a leasing division. And of course, in school, I knew nothing about leasing or equipment or that. But back in the 80s, for those who are old enough to remember that, leasing had a lot to do with taxes and tax deductions. And so I took a look at this entity as a white paper, as almost a consultant. And I said, we have too expensive of money and we don't have great credits for our companies. And so that I was very proud of myself because I had done what they taught me in MBA school. And he said, yeah, well, I could have told you that. Could you find something to do? And I basically said, well, I don't know how you fix that. But as part of that, we had 3 companies in the portfolio, which was supposed to be a AAA portfolio, that were startups. And even as, being out of school maybe 4 to 5 weeks at this point, I realized that startups were not AAA credits. And so I went down to Silicon Valley, which I was located in San Francisco, and to talk with these lessees. And I found that all of them were very interesting, and there was other security involved. And so I kind of checked them off the list as not being a problematic company in the portfolio. But one interesting fact all 3 CEOs told me was, you have a letter of credit and we would like it released, and we will give you options or shares in our company to do it. And I said, well, that's a very intriguing idea, but I think I'm supposed to bail out the portfolio, not to get it in more trouble. And that then led to really me coming back to a white paper and saying, perhaps we could actually lease to young startups where banks won't lease to them. And instead of just getting an interest rate, we could get equity in the company. We could also have it secured by equipment. And by the way, if they're backed by a venture capital firm, very few startups go out of business in the first 3 to 5 years. And that was a paper which is now really the theme of what venture debt is. And little did I know that that's actually what I meant to do. And to my great surprise, the chairman said, I like this idea. You go down and run this division. And of course, now I'm in week 16, and I said to him, no, I came here to work for you. And this was just my first assignment. And he said, well, if you don't, then you're fired. And so I said, well, I think I'll go down there and work since I don't want to go back on the job market. And that basically turned into be a great opportunity for me because I was only around 21 or 22 at the time. And it gave me, up to $200 million to capital. We did actually 3 years worth of investing in this product of about $400 or $500 million. And the product did very well. and it made lots of money, which allowed me to then start my own firm when I was 24. But once again, I think that the story from my perspective was, even though I was trying to get out of doing this and was forced with the basis that I would be fired if I didn't, that, sometimes you have to, take a gift horse in the mouth and then just go forward. So anyway, that's a little bit of my background. And people say that I, was very creative, very inventive. I say I was probably just maybe stubborn to the point that I almost got fired over it. But
well, it's interesting that the path that you were led down, and I want to move into this next area because your next venture dealt in some respects with this impact investing. And what exactly is impact investing?
Impact investing really just means, in my viewpoint, although it can differ with ecological companies or the green movement, but in my area, I really work on poverty, and really we invest in companies that really look at low-income people throughout the world as our primary market. And then that's as simple as that. We're trying to provide products to a certain population, which happens to be the majority population in the world, of goods and services that historically the poor don't get. And I always make the comment that the poor always get the highest priced products and the poorest quality, and they get disrespectful service. And so I always tell our companies that if you can treat this market as a true customer, treat them with respect, give them a good product, and make it at a fair price, you actually have literally billions of people that are open to it. And so that's really what impact investing does. Some people, I think maybe in my viewpoint, over promise that we're going to save the world, we're going to solve poverty, we're going to do this or that. In reality, I think anybody that's been around poverty knows that poverty is caused by tens, if not hundreds, of different problems. And one of the problems is that the poor always have to struggle with education, housing, getting loans, to almost anything else. If you can provide companies that provide those at a good quality and at a fair price, there is no trade-off between return and helping the people. But I would always emphasize that the low-income people of the world are really helping themselves. I mean, we only provide the products and tools that they should have had as any other consumer does. So that's really how I look at impact investing.
What do you see the biggest problem with family offices and philanthropy as it relates to impact investing?
I think the biggest problem that I see is that a family office's philanthropy and a family office's investing is quite separate from each other. And depending on the size of the family office, its foundation or its family foundation or whatever it might be is oftentimes run by different people than they're actually profit making. So impact investing is a perfect storm in the way that it's between the foundation and between the family office. So both of them have to communicate that, yes, this is appealing to us because of the impact or helping others, but it also actually provides a very good return. And that's really probably the biggest problem, is to get the two areas of most family offices talking, because they tend to be in their own little silos. There's certain amounts that are allocated to their family foundation, and there's certain amounts that are in the family office. So I would say that that's probably one of our biggest problems. And if you get the founder if the family office in particular, the founder is alive, and if the founder was an entrepreneur, we generally have a very easy sell because the founder likes the idea generally of young companies solving problems. And it's really just the structure of the family office that sometimes makes it very difficult.
Yeah, there was one of your experiences, I think, early on when you laid venture debt into the impact investing. You had a surprising return. I think the goal was a return, but I think maybe can you tell the story about how that came about and really what happened there with you're doing good work and
Yeah, I mean, I one of the areas as I got in impact investing with Unitas and some of my partners, and by the way, it's just certainly not me. It's like a lot of great people that are faster, smarter than me, is that we concentrated on what was called microfinance in the world, which is a fairly large market, which is really providing loans to the poorest, particularly women of the world. And we had basically been working with microfinance to basically put people together with existing microfinance banks that have experience in banking. To make a $500 loan to a person is easy enough, but to make it profitable, you have to do millions of these loans because of just the amount of volume. And we came into the field looking that most microfinance banks were started by very good-hearted people, really wanting to help people, but they didn't really know how to make millions of loans. They probably could do a few hundred, a few thousand. And so really combining the two together, which in some people's mind was heresy, because you didn't want to bring bankers into, a good cause. And at the same time, we said, well, bankers actually know how to run banks. And many of them are very good people. And so by combining the two of them, we actually then needed to grow these banks. And many of the banks that we had supported grew from, let's say, 50,000 loans to 5 to 10 million loans. And the assets under management, or the assets lent out, turned into billions of dollars. And we then had to basically start to raise equity for these banks, because before they were nonprofits. Well, when we raised equities, to make a long story short, nobody had ever exited a microfinance bank. So as I went out to go raise equity for some of them, we actually just said to them, really, nobody's ever made money doing this because that. And so I said to many of the close friends of the organization I was with, Unitas and Patamar, we think this will work. I'm not sure how we're going to get an exit. And of course, from my world in private equity, if somebody can't tell you how they're going to get an exit, it's probably not a very good investment to make. So I just said, well, it's going to help people a lot, and hopefully we can get an exit. Fast forward, microfinance kind of took fire in India between 2003 and 2010. The interest and the banks grew greatly. All of a sudden, a lot of venture capitalists were interested, a lot of other private equity people. And lo and behold, one of the first companies that we backed, was a company that then went public for almost $2 billion. So we had gone in, at a valuation of $4 million. 5 years later, lo and behold, there is an exit for us in a public offering. And so, as you kind of said, we had then returned multiples on the initial money to our investors, but the investors were a little surprised because they thought that they had maybe actually done a nonprofit investment. And later on, what I actually said out of this, Alan, was that if you're going to change the world, you have to have some risk. And anybody who says, oh, we're going to be able to change the world, but we're going to promise you a 3% return, which is oftentimes what people say in the impact field or whatever, well, you know that if they're really going to give you that rate of return, it's probably not going to be because they're taking risk. The only people that return 3% are usually government bonds. So we would say that just like in any venture portfolio, if we go out and back entrepreneurs and they can actually grow and be successfully exited, that the return is not related to the impact. The return is related to how good these companies do. So I completely reject the idea that impact investing has to be a quote-unquote subsidized asset class. It doesn't, because our returns have been probably better than most of my venture firms have done over a period of years. So sorry for the long background of it, but that's really kind of takes our position in impact, which is there is good returns, but there's also good, will that's actually done.
When you're evaluating an impact investment, what specific metrics are you watching?
I think that the way that Patamar does, firms, I should also say, different firms approach it different ways. We basically approach it, first of all, is this a good idea? And what are the entrepreneurs like? And candidly, the first thing I learned in venture years ago was that you invest in people, not ideas. So we look at the people, and if there's somebody that we think will be successful, then we back them along with an idea that, once again, is focused at this market, which is the working poor. And then from a due diligence side, if we think that that product will work or that service or is good, we then look at what the impact of that product would be on the people. And in most cases, impact metrics, which is a big word that people use all the time in impact investing, is really about how do you measure this impact. And we basically always emphasize that we should report on the impact, but we should also do it in a way that doesn't, create extra work for the entrepreneur. Because I'll give you an example. We once had a fishing company that was increasing the income of their average fisherman, and some academics at a large university had challenged us to say, well, simply because the fishermen are making more money, are they spending it well? And I said, well, I think it's probably a bad, you're basically doubting your own humankind. And I think we might be acting like Big Brother here. If we can get somebody to make more money and you're accusing them in some ways of saying, well, maybe they're all going to, the men are going to get drunk and they're not going to spend the money, et cetera, we can't have entrepreneurs going out to see what they do with their extra money. And candidly, I think it's offensive to actually do that, because the poor tend to be better cash managers than the wealthy. And so I've always trusted them. So we would say a good metric in this case is that the fishermen make more money. And from that, hopefully they get a better house, they get better education for their kids, they have more, a better food supply, et cetera. And to us, that is actually all that our investors generally want to know.
How do you go about balancing your financial return versus the social impact of investment?
Honestly, we don't. We basically only invest in things that will have a large social impact, but we also have to take risks, because the risk is basically, to me, the word return and risk are interchanged with each other, just like they would be in traditional venture. Is that if you're doing something new or you're revolutionizing a current market by consolidating more suppliers, distributors, et cetera, you're taking a large risk. And if you take a large risk, you make a large change, which has a large impact. At the same time, economically, you will generally have a much bigger return if you take risk and you're successful. Of course, if you take risk and you're not successful, then you'll have a very poor return. So I would always say, once again, that the return of impact should be no different than in venture capital. In some cases, we put it in a portfolio. We have, a number of companies, 20, 30 companies in the portfolio. And our hope is that 2 or 3 of them will do extremely well, and other ones probably won't make it at all. But at the end of the day, that still should give us an average return. So once again, we kind of at Palomar in the United States, we kind of reject the idea that return and impact are necessarily interrelated. We actually think that risk and return are interrelated. And so we make sure to have a company that has big impact, but at the same time, making sure that they're taking a risk to change the world rather than just to, put a low yield bond out there or something like that.
What advice or strategies can you offer for building a successful career in impact investing?
Well, impact investing has become very popular, particularly with young people today coming out of college. And I'm actually very glad of that, because it's showing that people are not just looking to make the most money they can, but they're looking for some social issues. Very similar to venture capital, I believe that the best way to come into the industry is to get experience by being either an entrepreneur or working in an entrepreneurial company, or theoretically working in another investment firm, maybe doing the same type of work in a venture firm or buyouts. But personally, I prefer to have people that work with me that have experience in different young emerging growth companies, because they then appreciate how difficult it is to grow a company. And just like in your own business, Alan, I think that, nobody knows all the difficulties that went behind to make you a success. The best way for me to then coach my people to make investments is for them to understand how difficult it is and how to make those coaching. So I would basically say it's better to have them have some experience in real life and then come into us rather than to start giving entrepreneurs lectures all the time without really having the risk on the line.
Well, Chester, it's been a pleasure having you with us today on American Dreams, and best wishes to you and Panama. If anyone's interested in becoming part of the programs that you're running or the venture funds, how would they go ahead and learn more about it?
Yeah, go to our website at panama.com, or certainly just reach out to me directly, and we'll get you to the right people.